Good morning. Today I'm going to talk about five stocks you can buy. Well, I'd say today, but really tomorrow when the market's open, that you can buy tomorrow for long term growth. So today is Sunday, October 8th. For those of you who don't know me, my name is Adam Kahn. I'm the Rational Investor. I hope you're all enjoying your weekend. Um, Hopefully, you're not impacted by the war that started in Israel. And to be fair, the stocks that I'm going to give you, I'm not real sure. We'll see tomorrow, but the markets could be off. If I were to make a guess, I'm guessing oil will be up, but this will have some impact on the markets short term. The stocks I'm going to talk about today, and I picked five of them, are for long-term gains. I've put them in alphabetical order, so it's in no order of what I like best or what I like worse. But I picked five stocks that I think have some long-term appreciation, all for different reasons, and I'll get into those reasons for each one and talk a little about them. So the first stock I'm going to talk about is Google. We all know Google, we know the search engine and everything else, but they own a lot of products as well. And they're just a huge company that's kind of like the blue chip of technology. They're also into AI, so you get a little bit of that as well. This year, they're expected to make $5.63 per share, whereas next year they're growing at over a 20% rate, and they're expected to earn $6.65. That's just the average estimate. So they're growing at over 20%. Their price to earnings is about a 28. So I think that's pretty good value for what you're getting in the stock. Let me talk about some of the other companies they own that you may or may not realize. The one I'll talk about first is where you're watching me. Um, I only found YouTube about a year ago, really a lot less in terms of starting to view it. And I think that's the direction of television. I mean, I think they're going to take over a lot of market share. When I look at my son, who's 12 years old, he pretty much lives on Google in terms of his viewing. He doesn't really watch TV. He watches a few like shows that we find and we watch together on maybe Apple TV or Netflix or things like that. But his primary place of viewing content is YouTube. My guess is that's most kids, which means the advertisements are going to continue to grow the same way that television companies had it during my life. They also own a company called AdSense, which manages the payment options and advertisers on YouTube and other parties. They own Android. They own Nest, Waze, which maybe a lot of you use. I don't. My brother lives by it. They also own Waymo, which is their version of self-driving, and a company that I looked up when I was looking at the company called Socratic, which is super cool. It's for students where they can take a picture of a question that they have, and they'll be able to get an answer and help in terms of their learning. It's a great outlet, like a tutor or something else. It's pretty cool. Um, I'll also put up a chart because I finally learned how to use picture in picture. So you can see how it's performed over the past year. A couple of the ones that I'm doing, I'm also going to show you the past 5 years to show how much they've changed over time. But Google's just been really consistent. I think it'll continue to be so. And it's just one of those kind of companies that you really want to have in your portfolio. The next company I'm going to talk about is Nextera Energy Partners. Its ticker symbol is NEP. Um, I'm a bit of a dividend junkie, and they're paying a 14%. It's probably actually a little bit higher dividend right now. There is a little bit of risk to it. I've mentioned that in other videos that the higher a dividend, the more risk a stock has in it. The thing is with Nextera Energy Partners, the news is out. They were expected to grow at like a 12 to 15% growth rate for their dividend in particular. But what happened is with interest rates rising and some of the other things going on with their energy costs and the things that they're into, they had to lower that estimate down to somewhere between 5 and 8%. The dividend at the time was around 10, 11%, and the stock collapsed and fell a good bit from there. Thing is they didn't say the dividend was in jeopardy. They pretty much said that the growth rate of the company is going to slow down, and not be at the speed they expected, which, to be fair, they're already really doing well. It shouldn't be that big a deal as long as they can meet that guidance. The risk in the stock when I was reading, they're trying to get their natural gas pipelines purchased, and that if they don't get that, they either have to dilute the stock by selling some more of it or take on loans which could impact the dividends. This is according to World of Dividends that I found online that got into a little detail of what's going on with the company. Thing is, I'll post their chart too, and you'll see the stock's fallen from 80 to 20. They're still a profitable company, which is why I really like it. And some things that I've owned over 30, 40 years, sometimes it's really wrong and I see them really get worse and worse and worse. But sometimes they drop from something like 80 to 20. They make a bottom there for a nice long time, and then they sometimes start drifting higher again. Now, you guys have to do your own research. I am not a financial planner, especially on something like this, but really on all of it, where you have to make your own financial decisions. I'm just a guy on YouTube sharing my experiences. So please don't follow me or use any of it. Like, really make your own decisions. This is just one I like that I'm willing to take the risk on, um, that maybe you want to take a look at and do your research as well. The third company I'm going to talk about is Pfizer. Now, again, I'm just doing them in alphabetical order, so don't read into any order of 1 through 5. But Pfizer's big pharma. I really don't see them going anywhere. They make a lot of money. They have a lot of products. They've been around a long, long time. It's a name I'm guessing most of you know who would be watching this. They're expected to make, $3.04 a share this year, just on average for the estimates, and they're supposed to make 3.46 for 2024. It's a pretty good growth for a company that big in the sector that they're in. And they've got a PE of under 10, actually under 9, based on this year's earnings when I looked at it. On top of that, they pay a dividend of close to 5%. So, like I said when I was talking about Nextera Energy Partners, I love dividends. If I can put some money into Pfizer and get paid 5% to own it, uh, I would rather take that risk than buying a treasury and getting the 5% that the treasuries pay, or CD, or things like that. I know the stock could go lower, but I do have the upside potential that it could continue to grow. They could raise their prices and continue to pay better on the dividend as well, or whatever they choose to do if they can grow their profits. What's hurt the stock is they've lowered their profit estimates for, the past two or three, not the quarterly reports, but their estimates on what it's going to make in the future, which has driven the stock from like 55 to 33. But that's what I actually like about it, is it's fallen a good bit. With all of these stocks, especially the ones that are on the lows, keep in mind these are for long-term investments. I'd hate to see people chiming in 2, 3, 4, even 6 months out, talking about, geez, you picked this one that's not doing so well. My long-term time horizon is 5 years or longer. I'm not looking to buy Pfizer at 33 and sell it at $40 in the next 6 months or a year or whatever it is. I'm looking to put money into it that I don't need, get a 5% dividend, and wake up in 10 years and hope that the stock has doubled. And like I said, hope. I'll repeat it. I'm just some YouTube idiot. You guys do your own research. Don't listen to me. But that's what I hope, is I can get paid 5%. Maybe I get lucky and the stock's moved up a good bit over time. So stock number 4 is probably one of my favorites, which is Target. Big, boring retail company. The retail sector has been, getting beat up in the news. On top of that, Target's been especially getting beat up because they're closing some stores because of theft. And their earnings fell from like an estimate of 1 billion to 800 million. But to be fair, they're still making over $7 a share. They're crushing it. And they pay a nice dividend as well. They pay around a 4% dividend. It's over $1 a share in the dividend. Well, if they're making $7 or $8 a share, paying a $1 dividend, there's plenty of room to continue to make that dividend. And we have the holiday season coming up. And what I really think is that it's not going to be as bad as people expect, and they've overestimated how slow it's going to be because discretionary spending has fallen so much. Thing is at least even me, as Christmas comes along and the holidays, It's not like I'm not going to get my son gifts or my wife or do the things we plan to normally do. Yes, inflation has gone through everything. Times are, we're all spending a little bit less. But when the holidays come around, we tend to find the money to do the things we want to do, which is why I think Target's going to have pretty good earnings and they're going to continue to be able to grow. Also, keep in mind if even if you're a gloom and doomer and you think inflation is a problem, understand that inflation should help retail companies. As inflation goes higher, they raise their prices along with it and their margins go up. They actually make more profits. One of the best things to own in inflationary times is stocks on average. So I wouldn't shy away from it. Target I love, and again I'll put the chart up. They've fallen from like around 180 a share down to 105, which is part of why the dividend yield is better, and I think it makes it a more attractive stock. Um, like I said, Target's one of my favorites. I just think they're in a good space, and I like my thought process, and this is just me making stuff up of what I think. If the economy slows down, things get tough. I think it's nicer to shop at Target than Walmart. So if people are cutting their budgets and trying to not spend quite as much, the prices are pretty similar, but it's a nicer environment, so it's somewhere I'd rather go. That's just me personally though. And I don't go to Walmart to buy our food products. I'll go to Smith's or Albertsons or something like that. So where I think Walmart might have a strength in terms of having those huge mega stores that also have the supermarkets, and Target's food section's a little bit smaller, even though that's been one of their sources of strength. I I would rather go buy stuff at Target. It's just better presented. And my number five stock that I have on my list of things to own that you can buy tomorrow for the long term, this one's completely different than the others. The one I put on there is Tesla. And I know that's a bit of a surprise because their PE is a little bit frothy. And when I put up the chart, you'll see, which I think you all know, it went from like very little to a ton in a very short amount of time. But what I like about Tesla is I think they've done something in the auto industry that their competitors just haven't had. My only concern is, as I'm looking around, I see the competition for electric vehicles just going through the roof. Like everybody has them now. There's tons of nice cars. I saw a BMW on the road the other day that looked really nice. Mercedes is getting them. I think even Bentley may have one. Not that we're looking at Bentleys, but the Lucid, I was really surprised that their price point is pretty similar, but they're very few on the road. And I even think that Rivian has that allure that Tesla did in the beginning, where everybody's really attracted to it, and there's something to that as well. What I like about Tesla as opposed to Ford and GM and what is it, whatever the Stella one, um, is the direct to consumer. I think that's huge. What I think the underlying problem is especially as we see the UAW strikes with Ford and GM and the others, is Ford and GM, they sell to a distributor who has a dealership and then they sell the car to you. And then they deal with the service and all the other stuff. Well, Tesla sells directly to the consumer. They own the distributors. On top of the fact, when you kind of look around, at least in Nevada, there's only one, if not two, and it's a very small showroom. It's not these big distributorships the way that the other car companies are, but they avoid that middleman. They also manage the service themselves, and they even sell the parts when the car's been damaged. And you kill the warranty if you use non-Tesla, a bumper, anything. So the mechanics and repairmen and everything else, they have to use Tesla parts, which means they really own all of it, everything that gets done. So when he lowers the price of the car and people get really worried about it because, oh my God, his margins must be going down. I think what they see is the more vehicles we put on the road, the more we make because we own every aspect of this. We're not simply selling a car to a distributor who then sells that to the public. We own the car, we own the distribution, we own the repairs, we own the charging stations. I mean, they're the equivalent of even owning the gas stations. The only difference is a lot of people charge at home, but I've been amazed over the years. So we bought a 2014 Tesla in 2014. When we used to drive around, at the charging stations, you rarely saw other cars. I mean, I don't want to overstate it. It wasn't like you were the only one there, but there were plenty of stalls, and there may have been two or three other cars there. When I travel now, you can get to a charging station. You may have to wait in line 4, 5, 6 cars deep before others leave, and you can actually get to a space. And the charging stations have gotten more and more stalls to them as well. So they've really grown on that end. So they own the gas stations, the repair shops, the dealerships, everything and anything about their car, and it's directly from the company without those middlemen. I think that's huge, and I think that's what gives him the ability to cut the margins on the sales, and it also gives him pricing power against the Fords and the GMs and the BMWs and the others. It's really incredible. I'm curious to see what happens in that field, and if Rivian and Lucid and the others are able to get over the hump and become profitable and get into there too. Even the Vietnamese one, Vinstar, I find that interesting. And I don't know how any of you watch that stock. It went public at, I think, $9 a share. The thing rallied to 90 in a week, and now it's below 9 over the next like month. It went straight up and came back down and crashed. I mean, it's pretty crazy. But I even, full disclosure, I bought 100 shares at $12. I figure I'll take the risk. If it goes to zero, it goes to zero. But I think America is helping to push the Vietnamese vehicles. Now, I don't know what that'll mean for their profitability. Um, just in terms of their politics of Vietnam and China and the US and everything else. Anyway, don't forget to subscribe, like. I hope you enjoyed the content. I'll remind you again, you need to make your own financial decisions and do your own research. But these are 5 stocks I like that I own all 5, and I plan to hold them a long, long time and just leave them in my portfolio. Enjoy the rest of your weekend. Um, Sending out my prayers for anybody in the East that's dealing with these wars. I hope they don't expand to other places. That's the one black swan that I worry about, where I could see yields on rates really spiking and things. I wish everybody the best, and I hope that it doesn't get worse. Have a great day.